Hi everyone, thanks a lot to be with us for this big talk powered by The Big Well. As a media, our primary mission is to bridge this gap between the crypto space and the traditional world. And today I'm very pleased to host Varun Paul, former head of fintech at the Bank of England, and now senior director and business lead for CBDC and financial markets infrastructure at Fireblocks, one of the main solutions for institutional investor. How are you, Varun?
Very well, thank you. Thanks for having me on.
That's great to have you because, as I said just before to start this interview, you are just in the middle between the crypto ecosystem and the traditional world. So I would like to discuss, the big news just happened at the beginning of this week, which is the Stripe just Akia bridge, a huge actor regarding the stable coins. They booked it for 1.1 billion. So this buyout is the largest ever made by one of the world's leading payment solution providers. So, and show that there is no doubt that stablecoins are a strategic sector for this player, as it's now anymore, I will say, a geek things, I will just say before. So, what is your view on this? And in all of this, where does Fireblocks stand? Because stable coins are very key metrics to measure, I would say, the adoption. So yeah, what's your view on this, and where does Fireblocks stand just in all of this adoption by stable coins?
Absolutely. So it's really exciting. Bridge is a great company that we've had the pleasure of working with as well. And Stripe is one of the largest payments companies in the world. I think that Stripe has shown an interest shows you how they can see the value of stablecoins in the future of payments. And B, the value they've attached to it shows you just how transformative they think it could be for their business. Obviously, they have the capital to pay for something at such a high valuation, but it just shows you that they think there are real gains to be made. And when you look at what stablecoins have done so far in the industry, they've shown their worth many times over for transferring value across borders, in particular, while maintaining the value of the token itself in a given currency. And you've seen a huge increase in adoption as a result of that over the past 4 or 5 years. In Fireblocks alone, we see actually more than half of the transactions we're seeing are in stablecoins. And so it's really shown that what people are trying to do, I think, more and more is use stablecoins as a temporary store of value between crypto transactions, really powerfully. But we're also seeing increasing use cases in the payments world. So using the stablecoin as a payment rail, moving value between end-to-end, between partners, between businesses around the world. And I think that's showing to have real value in terms of time saved, in terms of costs, and we can get into a bit more of that. But I think it's a real good indicator, as you say, of where the market is going and what it's been able to achieve so far.
And where Fireblocks is, I will say, in the scheme of this stablecoin adoption, because that's a wallet, not directly I will say a payment provider, of course. But what are you doing in this?
Exactly right. So Fireblocks, just to rewind a bit, Fireblocks is a custody technology provider. It provides wallet solutions to institutions all over the world. What that means is we use state-of-the-art cryptography to secure digital assets and help our clients to secure their own digital assets, both when they're at rest and when they're in transfer. And that goes from any digital asset, really. So it could be your Bitcoin or your Ethereum, but it's also going to be a stable coin as well. And what Fireblocks has really had some success in the past 5 years is working with financial institutions and those digital native, crypto native institutions who want to expand their digital asset journey. And we've been able to expand not just the crypto trading, but the use of payments, the use of tokenization, and many other use cases that are emerging every day, including NFTs for loyalty, for example. Now, in the payment space, as I say, you're simply holding and moving securely a digital asset. In this case, it might be a USDC or a USDT or a EuroC. And fundamentally, you want to be able to do so very securely with a clear, with lots of security and a very easy to use interface. And that's where Fireblocks plays here. So we're working with the institutions and helping them to access digital assets and move them around.
So, yeah, sorry.
Please.
So one of your main market, as you mentioned, is with the traditional financial institution. So where are they in terms of crypto adoption? Because that's interesting, because in your background, you were at a Bank of England. So that's very interesting to describe the adoption journey, what we are seeing, just right now in terms of stablecoins and crypto, because some people are separate the two things.
Yeah, so you're right. My perspective is relatively unique, having spent 14 years nearly at the Bank of England. And I guess what the move I made tells you that I think this really is going to go the distance, and it is going to transform the financial system. The innovations we've seen in the crypto world really are starting to translate to the traditional financial world, and stablecoins is the real first killer use case, is what we normally say.
And why, Varun? Why stablecoin? No, not crypto, but stablecoin, for example.
Well, let me rewind. When I was back at the Bank of England, one of the things I used to, as a regulator, we would look at it and say, well, look, crypto can't replace the traditional payment rails yet because of a number of reasons. One of those things is about the volatility of the asset and the ability to store value and to be used as a payment, especially if the transaction fees can move around quite a lot. Stablecoins address some of those issues, in particular, the stability of the value. And what people want to use when they want to make payments or transfer value in this way is something that will hold its value between the sending and receiving of that asset. The other thing that's changed, quite frankly, and this is where Fireblocks has, as I just mentioned, had an important role to play, is the security in the ability to hold those assets. And there have been various points in the last few years where people have been very vulnerable to hacking. And the kind of technology that Fireblocks brings to the market, using its multi-party computation and that deep cryptography that I talked about, and the layers of security, really makes it possible that these big financial institutions can start to engage. Because that was a big thing. You wouldn't engage in this market if you were at risk as a financial institution of getting hacked. And so we see real uptake in demand, and we have done over the past few years, and it is continuing to take off. And let me just go one step further. So that's a ground base level requirement. Can you have the right security and operations to do this?
Yes.
Yeah. Can you have an asset class that is stable enough to be used in the retail space? Yes, stablecoins do a lot of that. But there's more. And one of the other reasons why Fireblocks gets to be in the heart of all this stuff is we're part of the tokenization bit of this. So actually creating the token, whether it's a stable coin, and we're working with some large banks around the world who are doing this. Most recently, we announced working with Bancolombia in Latin America to issue a stable coin. But there are many others in the pipeline. We're able to help them tokenize those assets, create those assets, and then and do so very securely. And then really the point is they want access to the whole market. There's no point issuing a stablecoin as a one-off or in a small ecosystem. You want it to be adopted. But when it's adopted, then it's more useful. And then as the issuer, you're going to be able to get more value out of it as well. And when you think of the network that Fireblocks has, the over 2,000 institutional customers, that's really powerful for a bank or any other stablecoin issuer to be able to access. And so we're having a lot of success and traction in that respect, connecting this whole digital asset ecosystem together, whether it is the crypto traders or the big financial institutions issuing the stablecoins.
And why is particularly, once again, I'm asking the question, why particularly stablecoin? Because from my perspective, stablecoin, it's money, e-money, especially in Europe, for example. There is money market fund, tokenized money market fund. I will say in the future, the big hope is to be able to pay with a money market fund, or the part of the money market fund represent on a token on a blockchain. So, okay, because it's stable, why stablecoin? Because we can now pay with Bitcoin, with Ethereum. It's more complicated, of course, but why stablecoins? Why stablecoin convince so many institutional players to enter in this game?
Good question. So I think, and I probably am taking this viewpoint from my old role as well at the Bank of England. I think when you think about payments, it's different from holding an asset class. And the ability to separate those two things is quite important. So there's clearly volatility in the price of Bitcoin. And if you want to engage in Bitcoin for that reason, then you do so, whether you're trading volatility or holding it for reasons of growth. But if you want to use something for payments and you actually don't want that volatility, and that's for most people actually, for payments, you don't want that volatility. So stablecoin is really powerful. That's the first thing. Then there is actually what payments has, stablecoins has shown that it can do this end to end. And also it can do it on many blockchains, on any blockchain. And so the ubiquity of stablecoins across many different ecosystems, and Circle and Tether have done this very well at making themselves available to any market anywhere around the world. And that's where they gain adoption. Because the stablecoin use case at the moment is most powerful where the banking system really fails. And in particular, that is around cross-border payments, where the fees are very large. It costs something like 6% to make a cross-border remittance payment today.
And 6% is a good estimation. It's that's a fair price, I would say.
But I think the stablecoin can do it a lot cheaper, right? And also the really interesting thing that people forget. So it's one thing for a remittance payment for an individual. And if you think about using MoneyGram or Western Union, you're paying really big fees at the off ramp and on ramp. And so the stablecoin can do it end to end, and you can do it cheaper, but also you can do it so much faster. And for businesses, that speed of transfer is really important, because getting that money there within minutes rather than waiting for a correspondent banking system is super powerful. And actually the liquidity value of that end-to-end transfer is super powerful. There's another point here, which is that the stablecoin gives issuers a role to play. And banks in particular, and I think this is what we'll see next year, is more and more banks wanting to play a role here. They've seen huge market capitalization of USDT and USDC, and the revenue streams they're able to gain, because the stablecoin doesn't pay yield, but the backing assets do.
Right now, yes.
Yeah, well, good point. Right now, and banks are seeing this as an opportunity. So I think that leads us directly onto regulation. What we are seeing now, led by Europe, MiCA, is a clear regulation for what a stablecoin is and is not, and how it should behave. MiCA is leading the way, but around the world, what we're seeing is regulators are saying stablecoins should be a payment token, a payment asset, not an asset for speculation. And therefore, they should hold their value, and they should be redeemable at par, and they should not pay interest. If they're paying interest, they are more like a deposit, and the regulated system only allows a deposit to be held by a bank. And if you've got any other type of instrument, they're a security. So that will lead us to money market funds in a second. But I think because of the regulation, the stablecoin will always be a non-yield bearing asset, and it'll be used for payments in those jurisdictions that are heading in that direction, certainly.
And do you believe that's, I would say, more according to your opinion, do you believe that this strict separation between a yield, so fund, and currency, e-money or some stuff like that, not gonna fall soon? Because right now it's very easy on the blockchain, to own money market fund and to pay with it. So do you believe that it's like a kind of hypocrisy, because for example, I'm gonna use SDAI, for example. So it's from issue from MakerDAO. It's a yield bearing DAI, I would say, and there is so much product in DeFi right now. So do you believe that's not gonna fall soon, this to not be privated, in the future, in the close future?
Yeah, so let's go with a regulatory lens for a second. I think the reason the regulators will keep that distinction is that they have, over hundreds of years, set up a financial system in which you have a bank, and a bank has a really important role in the economy in a traditional sense. And that role is to take deposits and to lend out money. And that liquidity and maturity transformation is a really core part of the economy. Without that lending and borrowing, you wouldn't get the credit creation that drives a lot of growth. And that's a very traditional view, but I sign up to it. If everything was held in a stable coin that didn't yield any money, everything was in what we call traditionally a narrow bank, then you don't get lending and borrowing. and you don't get the same opportunities to transfer capital across different parts of the economy. Now, that role is so important that they regulate banks very heavily, because a bank that does that in a very bad way, as we've seen, will go
sometimes,
bankrupt and can cause real damage to people, hardworking people. And so they really want to keep that bit safe. And so anyone who is allowed to pay interest is regarded as a bank, and they're regulated as such. And so the regulators are able to do this, and they're able to say, well, look, if you are a bank, by all means, create a tokenized deposit. And that tokenized deposit is no different to a deposit you have today. And you can pay interest to a depositor in a way that you know the individual and you have an account with them. You're absolutely right there. What you're talking about really is money market fund is a capital market asset. It existed in the wholesale markets for many years. There is a degree of risk attached. Sorry, lost the lighting here.
No worries.
It's still good. And the money market fund has to be backed appropriately to make sure it maintains its value. Now, in a financial stability context, we would say that the money market fund has a risk attached to it, and it's different from the risk of a bank. And it should be held by people who understand that risk. Now, you're absolutely right that it's essentially generating yield. And that's really powerful if you can make that work in a more efficient manner that is accessible to retail customers, provided it's managed really, really well. There's always going to be a risk, and many stories over decades in financial history of money market funds breaking the buck and losing their par value because they've not been managed properly, managed that risk properly. So yes, I do believe that money market funds can be made more accessible using blockchains. We're seeing that today. I think that regulators will want to be very careful about how they allow that to be held and what they call them. So I think they will be very clear that a stablecoin is designed for a payment use case and should be called a stablecoin and backed in very clear assets and redeemable at par. A bank issuing a tokenized deposit has its own regulatory regime that protects it, and a money market fund is a slightly different asset.
And Varun, what is still missing? Because it's the adoption is accelerating, so we are seeing that. But what is still missing for the mass adoption from the traditional players still? And the other question attached to it is it realistic to say that public blockchain are winning or not? Or not completely, I will say.
Good question. So I think what is left? Certainly regulatory clarity. Where you've seen it in Europe, we're seeing more of a market emerge, and that's only just taking off now. MiCA is about to come into force properly, and you're seeing banks and non-banks gearing up to issue stablecoins. That will really help. The stablecoin really helps people, ordinary people, engage in crypto in a meaningful way, because they, as I said, they don't necessarily want exposure to crypto assets all the time, but they want to be able to benefit from the technology. I think that leads, the regulatory clarity means that you're going to get more financial institutions engaging. And as a result, we will see wider adoption. That's a matter of time. It's not a matter of if, it's a matter of when. Your point about public blockchains is really powerful as well, though, right? One of the challenges we see in the banking regulations is that there's a real negative stance on public blockchains.
Yes.
It's skewed very much towards private blockchains where you can have complete control, and there's this, I think, strange perception that a public blockchain has no governance at all, and you're at the behest of all sorts, and you never know who's interacting and who's operating nodes, and it's a very risky place to be. And I think that's a very old view, and I think that view needs to be updated, especially when you see degrees of permissioned blockchains coming in that can interact with public blockchains, for starters. There's a lot of nuance here. But more importantly, we've now seen, I think this is a really powerful milestone, we've seen BlackRock, the largest asset manager in the world, issuing a money market fund on Ethereum,
yes,
public chain. And I think people are going to say, hold on a second, if they can do it, why can't a bank do it? And I think we're going to start seeing more and more challenge that perception from the regulators. And I think that will transform the adoption, because until now, it's been very easy for a large financial institution to say, oh, I'm not allowed to use a public blockchain, So I'll build on something that looks a bit like a blockchain, but is actually a closed garden. And so it enables them to do some interesting things, some pilots, but it's never really going to enable them to do to make the most of the technology. And only when we get them using public blockchains or even permissioned EVM blockchains that interact with public chains, that's when we'll see some of the benefits. Because you need this whole ecosystem really needs to come together. There's no point having fragmented blockchains around the world, all doing their own thing, where you've got fragmented liquidity. If you want the large institutions around the world to engage, they don't want to have this locked up liquidity. And so whether that is because of the composability across an ecosystem, I mentioned the EVM ecosystem, but there are others, or because of interoperability providers that will connect these blockchains together, that's where I think we need to get to. And I think that is what I expect to see a lot more of next year. We're seeing a lot of announcements from the likes of Chainlink and Layer Zero. But there's other companies like Onera out there that also do some connectivity as well. I think it's really important to bring these chains and all these assets together more neatly.
You know, to finish with this topic, you have a presence, I would say, all over the world, and as you mentioned, there is more dynamic area or region in the world. So, why, which region are the most dynamic when it comes to talk about cryptocurrencies and stablecoins?
You're right, and we get to see we're present almost all over the world, and it's a fascinating part of my job that I get to see a lot of these markets. I tell you what I see is that there's appetite to use digital assets all over the world, and often it's held back by the stance of the government or the regulator. So we see real pockets of growth where the stance of the authorities allows them to experiment, allows them to make use of the technology. And okay. I'm going to highlight a few regions. We see lots of activity in Latin America. Brazil in particular, there's been a really positive stance and approach from the authorities, really engaging with the institutions as they do so, and therefore enabling retail customers and wholesale entities to engage in crypto and in stablecoins. We're seeing a lot in the UAE because the regulation, again, is moving rapidly, and they've set out a regime for stablecoin issuers, and that we'll see. And they've also been very welcoming to crypto companies in the UAE. And that, again, sets the environment for growth and for adoption. There are also pockets across APAC. And we think we're going to see plenty more happening in the next year. But we see a lot of movement in South Korea. We have seen past movement in Australia with some of the banks issuing the first stablecoins around the world, and we were involved in some of those. But we're expecting to see lots more in Japan as well in the next 12 months.
Okay, thank you for this part. Right now, we're going to talk about your strategy as I would say, a solution wallet provider. So today, everyone is launching a wallet. I would say, a DeFi protocol, a centralized entity, banks. So why should Fireblocks solution stand all these launches? Why are you so particular? If you want to compare to the other solution, where do you want to stand? With your solution. What kind of solution are you?
Yeah, good question. Let me go back to where I started this conversation. Fireblocks is a technology provider, and as a technology provider, it's actually it's a company that was founded and built upon cybersecurity first and foremost. As a result, I think we come to the market with a real pride in that security. If you look there's a paper we published last year called Bitforge, and it was all about highlighting in the appropriate manner where we'd spotted vulnerabilities in the use of multi-party computation in the industry in a responsible way that spoke to the issuers of the technology first and raised the standard of the use of this technology to secure digital assets. So Fireblocks is first and foremost a cybersecurity company that is raising the standard of using this technology in the digital asset industry. We then, if you think about us as primarily, first and foremost, a tech company, we want to be assisting other entities to make their journey in digital assets. We want to enable every business to be able to engage in digital assets easily and securely. And that goes right through from our first customer to every new customer we add every day. But it means that we've had to broaden from just holding that asset, as I described, to doing many more things. And we've engaged and broadened from just crypto custody technology to enabling payments using Fireblocks, the Fireblocks platform, enabling tokenization on the platform with our own smart contracts and with partner smart contracts, enabling you to have a very secure and compliant journey by working with partners on that offer AML and KYT solutions. And we've done a lot more in the kind of the Web3 loyalty space as well. So what you see is Fireblocks evolving in the past 12 months, I'd say, into an all-in-one digital asset platform, not just a custody technology provider. And I think that positions us in a very unique way relative to our competitors. Because yes, we provide that technology for custody, but really we're looking to provide an all-in-one solution for your full digital asset journey. The other thing is that our aim is to be an open platform. I mentioned partners a couple of times already in what I just said. And really you'll see in our most recent innovation in our tokenization engine, the use of partner smart contracts, because the goal is not to try and do everything for everyone on our own. The goal is to recognize that this is an open platform where other people are providing solutions that are really powerful, and Fireblocks isn't trying to do everything, but it is the place to start your journey. And I also mentioned interoperability providers as well. And we're working with them because they provide a really unique solution, but it complements what we do. And in my eyes, the goal is to be able to bring that all together and make sure that whether you're a small startup, starting right at the start of your digital asset journey, or a large financial institution trying to get to scale. And we have some fantastic brands that we already work with, whether it's the likes of Revolut or BNY Mellon. These are big companies with big ambitions, and we're able to take them from start to really expansion and scaling. And that's what's really powerful. That open platform, the idea that it's all in one, you can do everything, start your journey in Fireblocks and work with any number of the best partners out there to succeed in digital assets.
And sorry, Varun, you mentioned that it's an open platform. What do you mean by that? It's permissionless. It's it's like to have a platform like the Uniswap V4, for example, and everybody is able to build on this. So what do you mean by that?
Not quite in that sense. It's a SaaS platform at the end of the day. People come subscribe for our services and our products. And so, but when they do so, they get access to more than just things that Fireblocks have created. And we have a whole partner ecosystem. And my point is, for example, in that smart contract example, there are some competitors out there would focus on only their smart contracts and would keep a system where they have greater control and authority over what's being done because they've written everything themselves. Our goal is not that. Our goal is to say we are going to grow just as much when the market grows. And so we will work with partners. And that's really powerful. It means that we're working, as I said, with some of the best other companies in the world, driving the adoption of tokenized assets, driving the adoption of digital assets. And that's really powerful. Beyond that, I think if we go back to the core of what Fireblocks really succeeded in the first bull run, it was all about the fact that we supported many blockchains, many crypto assets, more than many of our peers. And that ability that was also an openness. It said you can hold any digital asset in one place. Now what I'm saying is you can do any digital asset use case in one place, and that's the power of Fireblocks.
Okay, I see. No, as we mentioned, so you are not only a wallet provider or a custody solution provider, of course, but we are seeing more and more wallets. They want to be like a neobank or a fintech, I will say, like Safe Wallet, Etherfi, or Gnosis. So, what is the future of the wallet? What will it look like in 5 years? Because now you have an IBAN attached to your wallet. Potentially, you have a credit card, you have a debit card. It depends. So, yeah, what is the future of the wallet and what it will look like in 5 years? That's very interesting to hear from you.
Yeah, let me give you something on the wallet landscape as it exists today. And this goes back to your previous question about the peers and the competitors in the industry. I think what we're seeing is there is definitely the market for wallets and custody technology, whether it's the Gnosis or the ledgers out there, there's lots of solutions out there. And some of them are aimed at the bottom end of the market. Some of them are designed to be the kind of thing you start off with maybe. But what we have seen, as I mentioned, is this challenge where, going back to really at the start of what I said, how can you be safe enough to hold these digital assets? How can you avoid the risk of being hacked? And really, I think what we have seen and we continue to see, unfortunately, is news stories of hacks, of assets being stolen because the wrong technology or the wrong procedures have been used. So I think it's really important that the industry either is able to recognize and raise the standard of how digital assets are held. And I think we will see either some improvements, evolution, consolidation even in the industry over the coming years. And some of that might even be driven by the regulation, because it might say, actually, you must use a superior technology, or you must have the right governance if you're going to hold digital assets on behalf of customers. So that's the first part of your question. The second part, I think, is that digital asset wallets are really exciting. I think it's some really cool stuff happening. Let me give you an example of one thing we're working on. But from a retail perspective at the moment, as you say, we have bank accounts, we have debit cards, credit cards, we have a mobile wallet, now we have digital asset wallets. I think we're in this phase where digital assets is complex. The ecosystem is complex for a retail customer to understand, and it puts many people off. It's equivalent to the development of the internet, and it will get simpler. You know, if you think about accessing the internet from your browser back in the day, 20 years ago, is very different to now just opening up an app on your phone, and actually all the complexity is now gone. We will get to that stage, I think, where once the complexities and the use cases and the innovation and the market has evolved, we will get simplification. And I'd love to see a world in which all those things you just described are integrated and seamless between one thing. And whether it's the debit card and credit card number is attached to a digital wallet, and we don't really perceive the difference. I think there's something broader about that, and that is about the types of money we use today. And I spend a lot of time thinking about this in the CBDC context. The types of money we use today are varied. We might use a debit card for one thing. We might use a banknote for another thing. We might use a stablecoin for something else.
Good point. Yeah.
And I think that will exist in the future as well. I think we will have different types of money. And I think central bank digital currencies will coexist alongside tokenized deposits and stablecoins and crypto. And I think we will want to use those different things for different purposes. What we really need to head to, though, is a world, a kind of more of a Web3 world. We're on our journey still, right? But the Web3 vision would put the owner in control of their assets directly, and their content and their data. And I think we're getting there. And there's a really interesting technology that we've been developing, which I really like in this context. And it's kind of a direct custody model, or an embedded wallet. And what it does is it does put the control of the assets in the hands of the individual. Not even as what happens today with most of our clients is actually the institution that is our client provides that custody to a retail customer. But in this case, the embedded wallet, the direct custody model, says actually the end user can be the one responsible for their private key. That's really powerful, except we don't want them being at risk of losing their password and then losing their assets. And we don't want to put all that pressure on them. So you're protected in a sense by a triangle of trust. And one is the tech provider, Fireblocks, and the other is the wallet provider. If the retail customer forgets their password, they can go to the wallet provider to reset their password, just like they do today. Brilliant. Web 2 solution, it works. If the wallet provider, however, has an operational failure or goes bust, what does the customer do? And in that scenario, they can come to the tech provider, to Fireblocks, to reinstate their private key and take that to another wallet provider. And that's really powerful in the right governance model. And what happens if the tech provider goes bust? And as today, that's true in this model as well, that they have a disaster recovery solution, and they can take they can reinstate their private key and have control of their assets and take it elsewhere. Now, why that's really powerful is, one, the end customer is in direct ownership of their funds in all those scenarios. two, the customer is never exposed to the wallet provider or the tech provider in a financial risk sense. And three, it means that actually you can have operational failure of any two of those parties, because the asset they're holding is issued by another party entirely. Whether it's a stablecoin issuer or a central bank, they're providing the money. And so actually they're holding this asset from elsewhere. And I think it's a really neat solution for the future, but I think we're only just seeing the starting of understanding how powerful that could be.
Okay, but can we imagine in the future many options to own your assets, your money, your currencies, or can we imagine one in the same place? You know, as you describe it, because to my perspective, it's a question of responsibility. For example, if you own your money in the bank, you want to a very high level of responsibility regarding that, or if you want to be in self custody, it's on you. You know, so can we imagine different level in the future, or is it realistic to think that's all gonna take place in the same in the same wallet or in the same place?
Really hard to tell. My hope, actually, for what it's worth, is there should be different providers. Exactly as you said,
Yes.
that bank is doing something very specific, and you may want, just as in the olden days, we might have had a safe deposit box. It's a very secure way to hold something very specific, and we had a bank account, and we might have had something else. I think there are different entities that we will rely on for different parts. So I think we will have underlying this different custody or wallet solutions. But what should evolve is a really simple user interface that sits on top of it all. We've talked about them as aggregators in the past, in the traditional world. And we've seen payment companies pop up in the previous decade that were aggregating bank accounts, aggregating debit cards, putting them all in one portal for you to look at your entire digital, not digital asset life in that world, but your financial life in one place. And I think that kind of solution will evolve, will emerge. So whether it's because you're doing it all on your mobile phone and the mobile app is the gateway to all this other stuff, or as I described just now, that digital asset, that embedded direct custody model could be the gateway to holding everything else, because you're still reliant on another party to hold the stuff you're holding with the bank, for example. But the gateway for that, the user interface is built on top. And that's where we get to the point, as I just described, compared to the internet back in 20 years ago and today, where you're able to abstract all that complexity away and actually make the technology work for individuals in a neater fashion.
And regarding the retail market, where we are about the security on the smartphone, because right now, as a crypto user, I don't really want to use one of my biggest wallets, I would say, on my phone, because it's still really risky regarding the private key and all of stuff like that. So where we are regarding that right now?
That's really interesting that you put it in that way. One of the most powerful parts of our technology actually uses the really secure enclave inside the phone. So the bit of the phone that has the Face ID and secures.
And how it's working? It's working?
So what it does is it uses that, and it stores a specific part of the cryptography is interacting with that secure enclave. And actually, when I speak to the cybersecurity experts in Fireblocks, and there are many of them, they would say this is the most secure way to do it. And actually, in many of our workflows, even for the largest financial institutions in the world, they're using, believe it or not, it's a key part of the security. Many of the layers we have, one of those layers is to have use that secure enclave inside the phone. So actually, as I say, some of the security experts would say the phones are very powerful in this respect, and because they're doing that in a very protected environment, rather than, and you're interacting with stuff online, obviously, but this part is actually in your hand, and that adds this layer of security. And obviously, you've got the biometrics on top of that. So I'm going to flip it around. Actually, I think actually the mobile phone is a real part of the solution here.
Yeah. For the adoption, and regarding that, where it's going to happen,
and the security, it's a really important part of security.
No, of course. And according to just what you said, where this mass adoption going to happen for you? I mean, mass adoption, that's going to be normal to pay with stablecoins, for example, and to buy some crypto with your bank or in a very traditional way.
Where or when?
When?
When, yeah.
Where? That's a good too. But
I,
when first? When?
when I think it's still going to take a bit of time. Let's be candid and honest. I think
5 or 10 years, or that?
I would say 5, not 10.
Okay.
I think we're going to see this take off. My hope is by the end of the decade, we will, and the reason we'll get there by then, I think, is we will see the big financial institutions using it more. I think we will see the use from retail customers, and that will force central banks and regulators and authorities around the world to say, actually, we now are a bit more comfortable with this. We need to challenge ourselves. So we will see central bank money as well on chain. We will see more tokenized assets, financial assets on chain, and that will drive that adoption. And it's really hard to tell. And previously, I would have said this year would have been a bumpy year, and it's been slower than we'd expected for the tokenized asset world. But again, we're seeing a lot more in this money market fund space. It does feel like the financial institutions are getting much more ready now. And so I would say by the end of this decade, we will be paying with digital assets much more. And let me give you one more reason. This is a complicated one, but AI has clearly taken off in the past 2 years, way faster than I would have expected when I was working on AI issues at the Bank of England just 2 years ago. And what we are now seeing very rapidly is the emergence of AI agents or bots that will operate on our behalf. Maybe they'll optimize for our financial lives, or they might optimize for our calendars, whatever it is. But I think we're getting to a world much faster than I expected, where we will have many more payment operators required to interact with the payment system. And they will be doing much more complex things than we can do today. And I think the payment rails of today can't handle that complexity. But blockchains carrying complicated messages, programmability, and smart contracts can. And I actually think that AI adoption will drive further the use of digital assets and blockchains in a way that I hadn't expected 2 years ago. So for that reason alone, given the speed of evolution of AI, I think it will contribute to the growth and adoption.
Interesting. All right. Interesting answer. Can you provide for us some figures about Fireblocks? I would say the number of clients, the amount secured, the AUM,
Yeah, so we have over 2,000 institutional customers on the platform. Since inception, over 5-6 years ago, we've secured in transactions over $6 trillion worth of digital assets. That's a big number, and if you think about it, that's 2.5 times the entire crypto asset market cap. So it's one of the ones that I like to use. But we're also seeing continued growth, and the number of clients is grown by upwards of 40 or 50% even this year, and we're seeing increased usage and increased transaction flows in this year as well across the Fireblocks network. It's grown by around 80% in the last 12 months. So it's really powerful, not only for the clients we have had and retained and seen them grow this year in particular, but also the new logos and the new brands taking on digital assets and working with Fireblocks to do so.
Okay, let's go into the last part of this interview. So you are using notably the MPC technology. So how does Fireblocks different itself from the competition? Regarding the MPC, for example, the MPC is used by many players right now. So why are you particular in this landscape?
Great question. From day one of the things is that we created our own implementation. It's a Fireblocks own one. MPC CMP is what we call it, and it was published as an open source. So actually, in years gone by, that publication means that others have been able to use that implementation, and as a result, it has, as I said, raised the standards of the industry. We also have, because of that cybersecurity at our core, we've had the in-house capability to always work and develop on this technology. And we have a huge technology team, huge cryptography team that genuinely separates us from the competition. I think our cryptography team is at least 3, if not 10 times larger than most of our competitors. I mentioned Bitforge, and it's worth looking that up, the publication last year. It's another example of where we didn't stand still based on the technology that we developed 4 years ago, 5 years ago. It's something we've continued to work on, continue to monitor in the industry, and try and keep other people's assets safe by enhancing the standards of MPC in the industry. So to answer your question, I think we were there one of the first in using MPC in this way for digital assets in this phase of the cycle. We made it open source so that other people could use this technology, but we've implemented it better than anyone else so far. And we have the expertise in-house, and that really separates us, that we're building this in-house, and we've wanted to enhance the standards of the industry.
Okay, interesting. And is it the best technology to use MPC, or are you looking for other in the future?
Of course, it's the best. We have it's the best thing we have out there. Genuinely, though, it is world class, and I say that not as a deep cybersecurity expert myself, but relying on everything that's out there in the market, and the proof points of the clients we're working with, and the track record we have of securing that huge number of assets in a very safe manner. And I think that's really powerful. Now, to answer your second part of your question, we're never standing still, and our R&D team is out there working hard on thinking how else we can make this even more secure all the time.
Of course,
because there are always threat actors out there, and you can never sit in your seat, sit still as a cybersecurity company in any field. And when there is increasing amounts of value in digital assets, the temptation for hackers just gets bigger. So Fireblocks would never sit here and say, we've solved the problem and we're not going to do anything else. We're constantly innovating and researching new opportunities to make the technology more secure. And that's absolutely true. So I'm sure you should expect to see more, whether it's in the next few months or years, I don't know, but definitely more to come.
It will be, it depends on you, of course, but it will be maybe my last question. In Europe right now, there is a big question regarding the classification of wallets providers or technology wallet providers services as regulated as custodians. How do you position yourself regarding that? Because, for example, I'm gonna quote Ledger, who's the one of competitors. They choose to not be or bet on the fact that they're not going to be regulated as a custodian, as a traditional custodian regarding the regulation. So where are you standing yourself about this?
Yeah, I don't think it makes sense to make bets in this space. I think it's very important to work with regulators. They set the rules at the end of the day, is my view. Now, everything we've done so far says that we are a technology provider, not a custodian. And there are key safeguards in that process that enable us to say that. Fundamentally, as I described, in all scenarios, the customer is the one who owns their assets, who's in control of their assets at all times. There are some competitive solutions out there where they will at times take ownership of the assets, or will take that responsibility, and therefore the regulator could classify them as a custodian.
But that's not your case.
Not in our case, no, exactly. And we see ourselves as a tech provider very clearly, much more aligned with the way that the regulators have looked upon cloud providers. So there's outsourcing rules around that. There are other rules around in Europe, specifically around DORA, for example, where the regulated entities, the financial institutions, have to comply with DORA for any critical outsourced third parties. And we're much more in the space of an operational provider to these institutions, not a financial risk, and therefore we're not regarded as a custodian.
So DORA is not you not have to apply to be compliant regarding DORA, for example.
So we're working through, in this space, this is the more interesting bit, and we're working with regulators on this. And so I think we have to expect that DORA will have an impact. Well, it will come to us, and we're working on the highest standards as always anyway. So it's not something we're worried about as such, but it's something we're keeping working closely with the regulators on to ensure that for the same ethos I just described before. We want to make sure that everyone is operating in the highest standards possible. And so if the regulators want to engage more on that respect, then that's exactly what we do. We want to make sure those financial institutions that are reliant on our technology are doing so in the right manner, and we're providing everything they need for that.
Okay, okay. I just ask one of the question regarding that, but I would like to have a more precise answer. I would say central bank currencies will emerge. You know, CBDC
Yeah.
in a few years. First of all, do you believe in a retail CBDC? Wholesale CBDC, of course. Maybe we can bet on this. But do you believe in a retail CBDC? Because from my perspective, there is so much better regarding stablecoins issuer, for example. They are doing quite a good job because their mission is to increase the level of the innovation. So maybe right now it's quite working. We can say that. So do you believe in a retail CBDC, especially in Europe or to the other part of the world? And for example, in the United States, they are not planning to launch a retail CBDC or even a wholesale CBDC.
Yeah, really good question. I've got a very clear answer on this. I think there will be retail CBDCs.
Okay.
I'll tell you why. I think let's start with the wholesale CBDC, as you said. People can see why it might make transactions cheaper, faster, smoother between the wholesale banks, for example. It just gives them a new payment rail to settle between them. And doing so in a CBDC has lower risk. Simple as that. What it comes down to is who is issuing and what risk they carry. And in most economies around the world, the theory is that the central bank or the government, the central bank as issuer of money, has a lower risk because they're essentially backed by the government and can print their own money. Now that in most countries means that it would have to be a government that completely collapses for that value to deteriorate, rather than a bank, for example, who is issuing money to deteriorate in their credit risk, or a stablecoin issuer who's not even a bank. Maybe they have made some mistakes in the way they're managing assets, the financial risk or the operational risk, and so the value of that money could change. So we tend to think about central bank issued money as a lowest risk asset in the land. Now, that's not to say that central bank, the retail CBDC needs to take over everything else. I don't believe that at all. What I firmly believe, as I said before, is it's part of the ecosystem. And the reason it is, and it won't come first, stablecoins are doing a great job right now. They're innovating, they're challenging, and they're giving us the ability to use digital assets to do things that we couldn't do before, whether it's moving value across, from developing parts of the world, rural parts of the world even, using blockchains. It's really powerful. And tokenized deposits will play a part of that. And as I say, because they'll have a different risk profile. I genuinely believe, just as we have today when we pay with debit cards or bank payments or banknotes, we do like to use different forms of payments, and
yes.
you want choice, actually.
Yeah, it depends on the situation, and of course.
Exactly. More than that, it also depends on you don't want to be stuck with one. Put it that way. You know, when Libra was announced by Facebook in 2019, one of the biggest concerns I had personally, and I know is shared by many others, is that it would completely take over the whole system. 1 or 2 billion users, 2 billion users, all using one thing overnight, suddenly would be amazing for our ability to use digital assets. Fantastic overnight. But you're at the hands of one company, and that one company has shown that they're really good at using data, for example. And so actually, we would be putting a lot more trust, not just our data on our social media habits, but our financial data in the hands of this giant technology company that would then have the ability to use it, maybe for good, maybe against us a little bit, maybe to sell us more stuff. But you're at the whim of one private company or a few private companies. And yeah, that's great because they innovate. It's fantastic. Private sector innovation is amazing. But there's always a worry. If you go back to public sector responsibility, I genuinely believe that there is a role for a government to play in providing a state-backed form of money. It doesn't need to be used by everyone for everything, but it should be there as an alternative, just as stablecoins should be used as an alternative. And I think the choice is what's really powerful. So I think central banks will get there. I think they're taking their time. I think they will, as I said, be pushed by the market first, which is great. But the really important thing for me, actually, is that when central banks build a CBDC, they must do so knowing what's happening around them. And therefore, the
Yes.
CBDC must work with everything else. There's no point creating a digital banknote if you can't hold it in the wallet that you hold your NFTs in, and you hold your tickets in, and you hold your digital assets in. So the key thing for me, and this runs counter to where Europe is at the moment, the key thing for me is that a retail CBDC must be compatible with the rest of the digital asset ecosystem if they want it to be used in 5 and 10 years time.
And like a backup or something like that, I would say, as you described a little bit.
It could be a cheaper version. It could be a private version. Actually, the
Yes.
way Europe is going, right? It's one that says we're going to protect your privacy with this thing, and no one will be able to track it. And actually, it's really powerful. It could be one that has zero cost because that's what the state decides. It could be the version of money that you have to pay your taxes in. Who knows? It will have a use, and if it doesn't have a use, then no one will use it, and fine, and we'll carry on our lives with tokenized deposits and stable coins and debit cards maybe. But I think it will find a use, and I think alongside in a vibrant digital asset ecosystem, it will play a part of the puzzle. It will be a piece of the puzzle.
Of the puzzle, yeah. Okay. Thank you, Varun Paul, former head of fintech at the Bank of England, as we discussed this interview, and now senior director and business lead for CBDCs and financial market infrastructure at Fireblocks. Thank you for your time. It has been maybe a really good conversation regarding the adoption, especially. And I remind the audience, or I'll tell to the audience, that we're going to host a breakfast of this question of wallet. What is the future of wallet in Paris? So the 7th of November. So you can find some details regarding this event. And maybe, Varun, I can invite you to come at this event that's going to take place in Paris. But before, I want to wish you good luck for your roadmap. It's like an habit in this podcast. And once again, thank you for your time, and see you soon in the crypto space and in the traditional world. Thank you, and on the big well, I would say.
Thank you very much for having me.